Hey guys, welcome back to the channel where price is a mechanical function. I'm Montana. I often get asked a lot, I want to buy a stock, what do I do? What should I be looking at? How do I do it? Anytime you want to go long, you want to go long in an uptrend. Anytime you want to go short, you want to go short in a downtrend. That makes perfect sense. But how do you look for those stocks, or how do you find, what's in an uptrend and what's in a downtrend? Well, the easiest way to do that is when you're looking at stocks is to check out the sectors. There's a lot of different sectors out there, but a very popular one or very popular ones are the New York Stock Exchanges. They're called spiders, and they're ETFs, and they're a really good indicator as to what sectors are doing well. You have consumer staples, you have energy, you have utilities, you have technology, you have finance, you have healthcare, and it's a cursory search. You can go onto Google ETFs or sector ETFs, and you'll find them. Um, but the really popular ones are the ones that are on the Nasdaq. I'm sorry, Nasdaq, New York Stock Exchange. And all you need to do is just find the strongest sector, and then look at the stocks in those sectors or in that sector. And if you want to go short, you go look for the weakest sector, and then you essentially look for the stocks in that sector, and then you go short those supply zones. But today I'm going to go over how to look over demand zones that you want to buy going long in strong sectors and in the stocks in those sectors. So let's jump into it. All right, so right here there's a lot of colors, a lot of lines, but it's really not as complicated as you might think. I just overlaid all the sectors, short of semiconductors because I'm not that great at technology, but um, here are the 11 sectors, I believe, that are representative of the entire stock market. Here you have utilities, finance, technology, so on and so forth. And I just put them in a line graph so it wouldn't be all too complicated, although it does look a little messy. But what you need to know is this. These two weakest sectors, this one is the XLE, which is the energy sector, E for energy. It's the weakest one. If you want to go long, you shouldn't be going long energy stocks right now because they're the weakest of them all. And here you have XLU, which is utilities, also not the strongest sector. All the other ones are the strongest sectors in comparison to, or relative to each other. So if you want to go long right now, the last thing you should be looking at is our energy stocks and utility stocks. You want to be going long everything else because they have the strongest uptrend. So this is kind of how you do it. Or before I get into that, another representation of how, or another way you can be doing it is just look at the straight sector itself. Sorry, this is the SMH. This is semiconductors. Also, you can tell this is a monthly chart, so every candle represents 1 month, and it's in a very strong uptrend. So semiconductor stocks, pretty bullish, going up pretty hard. XLB is building materials, right? Also strong. This is a really good example in comparison to this XLF financials, XLB and SMH. How XLE, which is energy, is a lot weaker. You can straight up tell that this is in a downtrend, right? So not that strong relative to semiconductors, building materials, and XLF, which is financials. So you would much rather go long these three as opposed to anything in energy, and then you can look at the other ones as well instead of doing this line graph. Like I said, you can just go straight to the ETF and just check them out, and everything else. This one, the the XLI industrials, also very strong uptrend. So you can just kind of tell. Now XLP consumer staples, that one's going, but not as strong. In XLU utilities. Sorry. Utilities also just took a pretty deep dive, at the beginning of 2020, and still hasn't made a higher high. So again, there are other stocks that you can be looking at in other sectors that would be a lot stronger to take. So then all you do after you find out what sectors you should be looking into and what sectors you should be looking into to go long, and what sectors you should not be looking into to go long, which in this case would be utilities and energy. Then you just find out, or you can do a cursory Google search, stocks in the energy sector, stocks in utility sector, Okay, I don't look at those. I can do financial stocks or technology stocks or healthcare stocks. All of those are doing great. And then once you get your list, and it would look something like this. Here I have XLB materials, XLE energy, and then XLF financials, and you just kind of get like your essentially your magazine of stocks, and you just start looking down the line at each one. Let's look under XLB. Let's go to Alcoa. When you start looking at these at these uh, at these stocks, you want to have multiple time frame analysis, which means a large time frame all the way down to a smaller one. In this case, I have a daily chart where every candle represents 1 day's worth of price action. That's the left one. The middle one is 240 minutes, which every candle represents 240 minutes, which is 4 hours worth of price action. And the right one I have 60 minutes, which is 1 hour. Every candle represents 1 hour. So what you want to do is, in an uptrend, you want to buy low and then sell high. So demand exists at the origin of large moves and also the origin of swings, of swing lows. For example, this is a good demand zone right here. You see how this is the swing low of the origin of a powerful move? Price is coming into it, so that's where demand exists. Now that's a very big zone, and this is why you do multiple time frame analysis. You get the big daily zone, which tells you generally where you should be looking. And right here, why does it keep doing that? This zone on a daily is this zone on a 240. Now again, really big, but we can make it smaller so we risk less. You want to get in as low as possible into the strongest zone. So within this area, you can say that this low right here, that's a demand zone, and then I'll even put this one, we can make this a bit bigger so you can see it. Right here, these two zones. So within this big daily demand, we just made our zones even smaller, and if you want to tighten them up, you can even do that. So this is demand zone 1 and demand zone 2. Those are the origins. This is the origin of this powerful move, and this is the origin of this powerful move, where you have a 90-degree ballistic movement out. The only thing that can make price move quickly out of an area, so 90 degrees up, is a lot of demand. And those demand orders, those buy orders, are still in the market. So when price re-enters those zones, or that area of overwhelming demand, price will bounce to the upside. Now, if price breaks below your zone, that's where you should have something called a stop loss, which is a sell order that will take you out of that trade because price is not respecting demand. It's continuing to break, which means it's continuing its short-term downtrend. Love your little losers. A little loser is fine. Big losers are not okay. If you have a little loser where you know, let's just say on each of those you're going to risk, each of those demand zones, you're going to risk $1,000. Well, if it bounces 5 times more than that, that's $5,000. You can lose a lot of $1,000 trades whenever your winners are making 5 times as much. You can be shooting 20% success rate and break even if you're using those ratios. Those are called ratios, where you're going to risk a certain amount to make a certain amount, and if half the time you make 5 times as much, that's pretty good money. So here you have your 240-minute zones, and let's see on a 60-minute if we can make them even a little bit smaller. Right here, this is that same area. Right here is the same area that we've been talking about. So within this, let's see if we can make, on a 240, that would be right here, and then we have it right here. Now that's the zone. That's pretty much the same zone on the 240, but here we can make it even smaller. You see this last candle right there? Now we made our zone even smaller, and now this is where ballistic movement really went to the upside. It moved quickly to the upside, which means a lot of demand. This is where it really is. And this one we can make even smaller. You see I kind of got the close and the open of those two candles just to make them a little bit smaller, so you're really perfecting your zones. And that's all you have to do, and just wait for price to come back into that zone. Let's put it here. When price re-enters that zone, you can make 5 times as much. Let's just say price falls into your zone and then rallies back up and you sell after it falls and then rallies, you sell here, you've risked $1,000. You from where you entered to where you exit, that's what, 6 to 1. You've risked $100 and you make 600. A 6 to 1 ratio is a pretty good half time. Let's just say 50% success rate. Half the time you make 6 times as much. That's not bad. That's a pretty good living. And that's essentially all you do. You just get good origins of zones on this daily chart. That's a good that's a good origin of this large move. Within that origin, you look into the areas where price moved ballistically from, and then you just make that zone smaller and smaller. And when price re-enters that, you just, well, you buy and then you sell at a ratio of minimum 3 to 1. You want to make at least 3 times more than what you're risking, and never trade without a stop loss. So that's essentially it. On this demand zone here and this demand zone here, you can also find smaller zones or more intraday zones. For example, right here is this area right here, this whole area. Well, where can we make it smaller? Or where can we perfect our zone a little bit? Okay, it would be right here. And then you go down to that same zone on a 60-minute and you'll probably make it even smaller still. And that's essentially what you do. You just start looking for those little coupons in price where if price re-enters that area, you go long. Then you go down to your next one, which is Air Products and Chemicals Inc. And you do the same thing. On a daily chart, this would be a good demand zone. And you're in an uptrend, so you want to wait for price to come back down, re-enter demand, and then continue the uptrend. And that's what price did here. Right here, you had a big rally in price. Wait for price to come back down, and then right here, look, it already happened. But you would have done exactly what we were planning on last trade. You just get your demand zone, and then you just wait for price to come back down, and then you buy those demand zones. Here it would have been, that would have been the demand zone there. It came back down, gave you a big origin of price right here where price left ballistically from. You put a demand zone there. That didn't work that well. Sorry, guys. You put a demand zone right there. Wait for price to come back down, and then you get your, right now would have been about a 3 to 1 ratio, and you cash out at 3 to 1, or let price continue to the upside and see if it breaks the swing high, which would be this. See how this is the current swing high where price fell back down into demand. If price breaks above that, then it will continue the uptrend. Uptrends make higher highs and higher lows, higher swing highs and higher swing lows. And that's essentially what you do. So you just find your demand zones and then just make those demand zones smaller on intraday charts and wait for price to come back down. This will be the last example. Let's not make this video too long. Right here, you have a fantastic demand zone here, right here on your daily. Awesome. Let's see if we can make that zone a bit smaller. That zone, that daily demand zone on a 240 is right here. Well, there we go. We're already making it smaller. We can just get the wick. We're already making it smaller still. And now within here, we can see that you have two little demand zones here. You see you have a rally, a base, and a rally. That base is this little doji candle here. Right here. You can have that as your zone within your daily demand zone. And then let's just kind of get this swing low and right here. And you have two little small demand zones there that you can take long instead of buying the whole demand zone, the whole daily demand zone here. You just made it smaller. So you have one demand zone, two demand zones, and you just do nothing until price comes back down into demand and expect price to bounce to the upside, and then you make your profit. It's as simple as that. So all you have to do is, when you're looking at stocks, and this doesn't matter if you're looking at currencies, futures, option stocks, cryptocurrency, it doesn't matter. Like I've said before, a chart is a chart is a chart, which means price action is all the same, no matter what asset class you're looking at, because it all works off of supply and demand. All markets are supply and demand. So if you look at any chart, it does not matter what asset or what market you're looking at. So if you want to go long, you find the strongest sector, or the strongest sector in any stock market, for example, and within that sector you find stocks that are having a good uptrends and giving you good demand zones, and you just wait for price to come back down, and if they're not in a good demand zone, you don't buy, because you want to buy low and sell high. So you find those demand zones, and then every 2 or 3 days you're just giving them a good look, see if it's getting close, and if it is, then you put your order in. Where in this case you want to, let's keep it simple and use this 240-minute chart. You would buy right at this price level, or right at the first line, which would be like 1943, and you will sell right as price breaks this 1896. So you would sell for a loss at 1895. It should not make lower lows. It should respect demand zones. And there you have your buy-in and then your stop loss. So it's not going to go against you 25% of your account or something like that. You love little losers. And then when price enters demand, then you sell high at a minimum of 3 times more than what you risked. And that's essentially it. So go long, strong uptrends, and then go short, strong downtrends. And in the next video, I'll go over how to hunt for short trades, or how to find good shorting opportunities. All right, guys. I hope this helped. I'll see you on the next one. Take it easy.